Sean, very good to see you. Today, we are talking through the concentration risk lurking in your portfolio. A lot of investors have large positions in S&P 500 index funds or in mutual funds that use the S&P as a benchmark. Stocks are up quite a bit this year, which is good news for your portfolio, but most investors probably don't realize that 80% of the gains we've seen this year are due to only 10 stocks. Here's what that looks like. This chart from FinViz, which shows everything year to date. So what's going on here, Sean?
This is a fantastic chart, Erin. If you look at this chart here, each box represents a separate company within the S&P 500, and there's 500 of them on this little screen here. The size of the box represents the size of the company within the S&P 500. So you can see on the left, Microsoft, Apple, NVIDIA, Google. These are huge names, okay? And you can see the performance alongside of them. What this means is because they are so big, as they go, the S&P 500 goes, because there are such a large weight in the S&P 500. They've done really well this year, and that's pulled up the S&P 500 overall. If you look over to the right side of that screen, you can see a lot of smaller names, and many of them are red or a shade of right? That means those are negative, okay? So overall, the S&P 500, yes, it's done well, but it's not really representative of what's going on in the overall U.S. market. You can see here that so many names, especially the smaller ones, just haven't performed that well. So this risk here is pretty large, Erin. Those names that brought the S&P 500 up, when they go down, and they will, it's only a matter of time because stocks go up and down. When those large names decline in value, it's now going to pull the overall S&P 500 down along with it. So this concentration risk is something we haven't seen in a long, long time.
Yeah, no, you're right. Not in 15 years, since 1973. So just to underscore it, what is the risk then that this presents? Because we're all riding high right now. What's the problem?
Well, we're riding high because of 10 names. If those 10 names turn and start doing poorly, it's going to pull that S&P 500 down. So if you have an S&P 500 ETF, if you have a mutual fund that's managed against the S&P 500, it's going to have a lot of these big names. As those big names decrease, so will your portfolio. It's so important to have good diversification. You want to have investments that aren't just in the S&P 500. Okay, so you're going to want to have some small names. An example of that would be the Russell 2000. You're going to want to have some mid-cap names. You're going to want to have some non-US names. MSCI EFA, which stands for Europe, Australasia, and Far East. That's a great benchmark of companies outside of the US. You want some emerging market names in there. So you've got to get beyond the S&P 500. All right. It's a good kind of benchmark, I guess, for the U.S. markets, but it doesn't represent the investable universe. You want to have that diversification because if the S&P 500 comes down, you want those other investments that are hopefully going to be stable or maybe even go up.
So as we talk through the considerations that you have, of course, diversifying beyond the S&P, next you say consider buffered ETFs.
Buffered ETFs are relatively new on the scene, Erin. They're great investments. So they're exchange-traded funds, meaning that you can buy and sell them at any point during the day. And they're pegged, or they're benchmarked, if you will, to the S&P 500 or another index, such as EFA I mentioned. So the way a buffered ETF works is if you hold it for 12 months, you have a defined outcome. You're going to get the performance of the underlying benchmark up to a cap, meaning you're not going to get more than, let's say right now, it's about 14%. But when or if the benchmark that you're pegged to is negative, you're going to have some measure of protection on that negative return. Sometimes it'll be as much as 30%. So if the S&P 500 is down, for instance, 40%, if you have that buffer with the ETF with the 30% buffer, you'll only be down 10. It's going to protect you on 30% of negative returns. So that's a great way to hedge against a down market with some nice upside potential.
And another consideration would be structured notes. And this isn't something that you can just walk down to the local bank and buy.
No, you can't. We negotiate these structured notes directly with different banks every single month. Here's how they work, Erin. They're issued every month by a large bank, and you go ahead and you buy them. And in exchange for buying that note, the bank is going to pay you an interest rate, and they're pretty good interest rates, Erin. Right now, they're right around 12% or so. You're going to get your money back at the end of those 12 months. However, you're going to get that money back based on how the stock market performs. I'm going to bring in that 30% buffer again. If the stock market is not down more than 30%, you're going to get back your full principal. If, however, the stock market is down more than 30%, you're going to be tied into that negative return. So if you put $1,000 into a note and the stock market's down 35% at the end of the year, you're going to get $650 back. You got that interest along the way. So I like these in portfolios. You don't put everything into this. It's a nice way to, again, diversify. Right. You're going to get some nice enhanced yield or interest rates on that. You're also going to get, if you think about it, 30% protection if the markets decline. So it's a nice way to diversify a little bit, get a little extra yield, and introduce some protection to your portfolio.
I really love this peek under the hood, Sean, to see how things are actually working. This was very helpful. If somebody wants to talk to you more about how they can be more diversified, what's the best way to reach you?
I'd encourage folks to call us, Erin, 603-715-2335. That's our direct line. Give us a call. We can set up some time to chat. If you want to get more information, if you want to dive into our website and look at other information we have there, that's daviswealthmgmt.com. And if you want to schedule time with me, click Connect with an Advisor, and you'll be able to put some time right on my calendar.
All right. Sean, thank you.
Thanks, Erin.